So, when out at dinner with friends or sitting in the bar after hockey, I often get asked the question by various people about the whole topic of alternative investments, infrastructure, private equity, private debt. And over the years, it's become clear that while those transactions have become very much mainstream in the financial sector, it's still a bit of a mystery to business owners and to investors. I get asked the question a lot, and so I've been doing a little bit of thinking about how to put that whole topic into context with the view to helping A, business owners, and B, investors understand the implications to them. So, to really understand what's happening today, you have to go back into history, because the rise of alternative investments has really been driven by three significant factors: technology, regulation, and interest rates. So I often get accused of being an old guy, so I'll tell an old guy story. Actually, it's our chairman of our firm here, a guy named Bob Williams, started at McLeod Young Weir in 1969 as a salesperson. And I was talking to Bob one day and I said, well, what did you sell? Stocks, bonds, money market, government bonds? He said, well, yeah, I sold all those things. Oh, really? Okay. Who'd you sell them to? Retail, institutional, government? Yeah, I sold them to all those people. And then the next question is, well, how many people at McLeod Young Weir had the sales job of selling all products to all buyers? And his answer was that in 1969, there were 20 people selling all products to all investors. Now, the end of that story is that when he was to go in to sell a government bond to a buyer, the bond was actually in his trunk. He would sell the bond, he would pull it out of his trunk, he would sign it over and take a commission of 1%. And for those in the markets today, the idea of getting paid 1% to sell a government bond is like, living on the moon. What has happened since then is that technology, in the same way that it's affected our day-to-day lives, has radically changed the nature of the capital markets. Many of us probably remember sitting at the kitchen table with our mother or father looking at the stock pages on the weekend. I know in the case of my dad, that's how he could tell how his investments did that week. He would get the Globe and Mail, look at the stock tables and a piece of paper and a pen, and he'd look at what his stocks were. Well, try to imagine that situation today. Originally, we had stock markets with people waving their hands around. We had stocks that traded based on eighth of a dollar increments. What we have now is we now have essentially eliminated the ability for any really human interaction on the markets. Stocks trade for fractions of a cent. Commissions have gone from a bid-ask spread of an eighth of a dollar down to fractions of a penny. And there is really full transparency in capital markets. Everybody knows instantaneously on their phone what their stock portfolio is going to look like. The impact of that, of course, is that the old saying in the capital markets is where there's mystery, there's margin. In the public stock markets and the bond markets, there's really no mystery anymore. Basically, everybody knows what prices are all the time. And as a result, the margins for doing basic things for investment dealers have really shrunk down quite dramatically. Now, from an investment point of view, that's what technology has done. From a regulatory point of view, if you're an investor, it used to be that you would buy stocks and bonds based on a hot tip or your broker having an analyst with special information. Well, because of the scandals that happened over the last 20 years, we've all as a society come to the view that somebody having special information is actually a problem. And so the regulations that have been built up over the last really 15 years have essentially made it illegal for anybody to have a different set of material information about a public company than anybody else, which from a policy point of view and from a market efficiency point of view is a very good thing. But from the point of view of how the markets worked, it's actually radically changed the relationship between investors and brokers in regard to what their role is. So as a result, in the kind of generic public markets, there's not much margin, there's not much informational advantage. So it's very difficult for the manager of a fund to earn their fees in creating above market performance when really everyone's on the same playing field. So the old adage that if you really want to make money by investing, get invested early and stay invested, get your asset allocation right, is pretty much all there is for public market securities, which again I think is good for investors and is good for market efficiency. But it's not good for the fund management business because those folks get paid to create an advantage. Otherwise, why are they doing it? The financial markets, in reaction to the inability to operate in the way it used to work, has essentially developed two main strategies in order to stay relevant in regard to people's investments. The first is to provide additional services, life insurance, financial advisory, estate and will planning, etc., for individuals, and that sort of thing. The other main opportunity has been this thing called alternative investments, which is essentially investments that are not liquid, that don't have published prices, where a professional manager or negotiator or private equity manager feels and may in fact have a proprietary advantage in executing that investment strategy. So again, we've talked about the impact of technology on information and prices. We've talked about regulation. The third factor has been interest rates. We have been in a scenario for the last roughly 15 years where interest rates have steadily declined. And as a result, stock market valuations have steadily increased. There's great anxiety out there that if interest rates go back up again, the stock market is going to have a big correction, bonds are going to lose their value, stocks are going to lose their value, and so there is a great deal of apprehension about any returns that are correlated to capital markets. So there's really two reasons why alternative, i.e. non-public investments, have become kind of the hot topic. The first is the expected ability of the managers of that money to create incremental value, and secondly, the desire for investment returns that are not correlated to interest rates or the stock market. Hence, infrastructure investments, things like toll roads and bridges, power plants, things that earn their money over a long period of time in a very steady fashion, become very attractive. And also investments in private companies, the private equity market. Again, going back 15 or 20 years, the big public sector pension funds, Canada Pension Plan, teachers, OMERS, etc., who are essentially very big pools of capital that don't need to worry about mark-to-markets and day-to-day performance. They made a strategic decision to get into private market investments, and over time have produced some really tremendous investment returns. So there's been a number of different factors which have pushed a lot of capital, a lot of interest into the space of, well, let's invest in companies that are not public. Let's invest in assets that are not public, and let's increase the allocation of our portfolio to those types of investments. Historically, that non-public allocation 30 years ago would have been 5% to real estate. Now, conventional wisdom is that number should be 20 to 40% of net investable assets should be invested in private market investments. And so here we are today. What we've had is a tremendous flood of capital into the alternative space, and that capital has to be deployed. If you were to ask me 10 years ago, what did a private company need to look like in order to be attracted to a private equity investor, I would have said, well, it needs at least $10 million of EBITDA or earnings before non-cash items to be attractive. That number today is 2 or 3 million. I would have made an argument that actually only certain types of industries really are qualified. Really, there's so much money chasing these deals that really the vast majority of companies actually are attracted to that space. So, to get back to the original question, what does all this mean to somebody who is a business owner? And those people that talk to me in the hockey rink and in Tim Hortons, invariably they fall into two categories. People who've got a little bit of money they want to invest, they want advice as to how to do it, but more commonly, people who own companies and are trying to figure out whether to sell or not. So, what has happened to the valuations of those companies is they have skyrocketed. Now, there has historically never been a better time for the owner of a private business to take a hard look at selling their business, because in fact, even if you adjust for the differential fees that private equity managers get paid versus public equity managers, because there's a difference there, if you make that adjustment, there really is not a material difference between the valuations in the public markets and what good quality companies are getting in the private markets. And that has historically never happened before. So now is a great time to consider selling your business because, well, just the values are really very good. That's the good news. The bad news is that all of the people, frankly, like me and like people at our firm, 15 years ago, 20 years ago, would not have really considered the private markets as particularly attractive places to work. Public markets was where it's at. That's where all the energy was. That's where all the money was. That was sort of considered to be the place to be. Because the margins of public market deals have gone down, because a lot of money is going to work private markets, a lot of that personal horsepower and those very sharp, tough people have changed careers and are now actively trying to find and trying to negotiate private equity deals. So what that means, though, is that yes, those valuations are available, but you really need to know how to deal with that community, because the market today is full of a lot of really smart, sharp people who do this every day, and the average typical business owner only does this once or twice in their career. So what does that mean? It means that if you are planning to take advantage of this, you have to get prepared. And in our next segment, we'll talk about what that means and what some of the strategies are to be able to actually achieve success in that market.